I'm going to put in a personal story of my mother and my grandmother and my great-grandmother, right? What is long-term care? What does that even mean? And paying for care, how do we pay it? You know, paying for long-term care, it's private pay. What that means is if you need long-term care, you pay for it out of your own pocket. And if you don't have the resources to pay, you've got a really big problem. So we're going to talk about how to pay for it. We're going to talk about options for coverage. So what type of coverage options are there if you choose to go the route of long-term care insurance? And then we're going to go over the general plan. So this is not so much the mechanism for funding the insurance, but essentially a care plan, a financial management plan, and all the other legal documents that you really, really need to pay attention to in order to make sure that you're effectively caring for yourself, frankly. And then we'll wrap it up with a Q&A. There's a disclaimer. I'm a lawyer. My lips are moving. Words are coming out of my mouth. This is not legal advice. Christina, do you want to give your disclosure or your disclaimer?
My disclaimer is that we're separate entities. So CunninghamLegal and Ascent Wealth Management are separate entities, and there are various means of financing long-term care, whether it be insurance, whether it be investment products. So by no means is this any particular investment advice. It would have to be a one-on-one recommendation, but we want to kind of go through the examples.
Great. So I'll start off with my personal experience. This is my great-grandmother, and she passed away in her sleep after a very long life listening to her favorite radio show. And at the time, she was living in Keokuk, Iowa, which my family came out during the gold rush, made it as far as Nevada, started ranching, made a bunch of money, went back to Iowa and bought the farm in the good sense. But they bought a farm in the 1860s and then kind of lived there. And she was one of the descendants of those pioneers. My grandmother, okay, so my great-grandmother died in her sleep. My grandmother had a heart attack and was on a ventilator, and it was a complete catastrophe. No one had a plan. It was pandemonium. It was hurt feelings in the family. And that was 20 years ago. And some of those hurt feelings are still around. Not a good outcome. And then my mother will probably spend, on average, she turned 76 this year, average 4 to 10 years in a nursing home because our healthcare has advanced. So it used to be that you died in your sleep and then you have a heart attack. And now for many, many people, this is growing population of people who will spend a considerable amount of time in a nursing home. And the number, I think, is well north of 50%. So if something is likely to happen, you've got to plan for it. So a lot of people have no plan in place. And they just think, well, my family's going to provide the care, right? I'll take my daughter will provide the care. Many times, by the way, it's the daughter who provides the care. And many times those responsibilities are not exactly shared equally. That's a very nice way to put it. So my mother-in-law recently passed away a couple of months ago, right after this kind of COVID thing broke out, and she was in a nursing home and had dementia. My wife was the primary caregiver, and she has 3 older brothers. And I can tell you from personal experience, she did most of the work. I mean, most is generous to my brothers-in-law. She's the one who had the responsibility for the care. And I know that it causes tension. It does cause resentment. And I can't tell you how many times I've had spouses and kids come into my office and they say, Jim, I've been caring for my spouse or my parent for 3 years. I haven't had a break. I'm done. I'm so burned out. I need to do something. So you got to help me out. Okay. A lot of these people have hit a pause on their careers. The leading cause of absenteeism for executives over the age of 50 in the United States is caring for an elder. It's a big deal. It's a big deal in business. And oftentimes these are the more, shall we say, responsible people who end up caring for the elder. So many times they have careers and family life. And believe me, it just gets disruptive. And the whole process of long-term care really can tear families apart.
Jim, how long did your mother-in-law have a caregiver?
She had a caregiver, I'm going to have to do some quick mental math, for about 8 years.
Okay. And the average, you mentioned the loved ones caring for caregivers, right. And I wanted to highlight that Lincoln Financial came out with a study that showed that the average life of a caregiver is shortened. If you're a caregiver, it typically takes about 7 years off of your life. So being a caregiver is certainly no easy task.
I mean, just look at this. Men need an average of, women need almost twice as much care as men. So if this nice looking lady here cares for her wife for 2.2 years, then she needs care. Will there be money to care for her? Who's going to be her support network? These are really, really important questions. And if you're single, it's even, it's even a bigger question, right? If you're not caring for somebody else, who's going to care for you? 3%, this is interesting, 3% of long-term care occurs in a nursing facility. I think a lot of us have a mistaken belief that, oh, if something happens to me, I'll go to a nursing home and I'll be there. Oh, and by the way, the state will pay for it, or the federal government or Medicare will pay for it. Doesn't happen that way. 85%, this is a huge number, folks, 85% of the care is received right at home, and you pay for that care. And that is not an insignificant amount of money. They kind of got by just to kind of do a follow-up on your question, Christina. My mother-in-law and father-in-law had a caregiver, and they were able to limp by and pay. They hired someone under the table, which I said, don't do that. Then that person didn't work out. Finally, they hired somebody through an agency. One of the biggest growing areas in labor law are people working for elderly people as an in-home employee, and they're not paid right. California, employing anyone in California, you've got all these regulations, all these rules. And so best practices, just one takeaway from here: if you're going to hire a home health worker or someone to help you in the home, please consider going through an agency. Yes, it does cost more, but you're not going to be the target of a lawsuit. We have a client who's 101 years old, 101. And she had a caregiver in the past sue her successfully, and she had to write a check for several $100,000 because she just wasn't following the rules. So very, very important. 90% of married couples, 90%, look at that, age 65 and over will need some form of long-term care coverage. But Christina, what does it say here? 14% of clients? I mean,
yeah,
to me, I can't even believe that. Tell me a little bit about your industry. Why don't they recommend it?
Long-term care, sometimes it means repositioning other existing assets. So sometimes it might mean that there's less investments to manage for a financial advisor. That should never be a concern. But what we do want to make sure, especially as a certified financial planner, my job is to look at things holistically and look at what a long-term care event could do to someone's retirement plan. And if they're not prepared, okay, it might mean that we take a little bit of assets and reposition now, and we're managing a little bit less as an advisor, but we're preparing for not damaging their retirement and really imploding their entire retirement plan.
That is so important. So this is scary.
This is scary.
This is really, really scary. If you hope to make it past 65, which I do, haven't met anyone who says 65 is old enough. Or if you're over 65, look at that. 70% are going to need some form of long-term care. And I can tell you, in my family, my grandmother passed away of the heart attack. My grandfather needed long-term care. And in my wife's family, both of her parents need it. So that's the statistic right there, right? 70%. That's it.
Exactly. So the top 5 reasons for bankruptcy, interestingly enough, the number 1 reason is an unfunded long-term care event. So, medical in general, people often hear of medical being a reason people go bankrupt, cancer, other things, but the number 1 reason is an unfunded long-term care event. So, to go to the cost, and what we're going to see here is the average cost has gone up. So, Jim, if we want to go to the next slide, we kind of can get into the average cost in California. So the average cost in California is over $10,000 a month for a private room in a nursing home. when you and I did a long-term care educational webinar last year, that number was 9,700. So it's gone up
Wow.
nearly $1,000 a month in California just in the last year. And so, you know, if we go back just one, we can take a look at, for home health care, sorry, if we go forward one over to the average cost. Whoop, you're moving fast. There we go.
Sorry, I'm clicking a lot of buttons. I'm like everyone else, I'm trying to learn Zoom.
No worries. And so what we can see is, you know, most people want to have either a private room. They don't typically want a semi-private room. If they're in assisted care where they need some care, you know, that's not that expensive. $4,500 a month is not bad for an assisted care. And that might be when you're not quite tapping into your long-term care policy because you don't need full-time care, but maybe you need some, you know, maybe you have two, and we're going to get into the what qualifies for long-term care, but maybe you have two of the activities of daily living where you need help bathing and you need help eating. So maybe you are in assisted care. But what it really starts to get expensive is the more needs that you have that you need care for. And a lot of times people want to stay in their home. So it is important, we'll get into the policies that we're going to talk about is are policies that allow someone to stay in their home. But even home health care, $64,000 a year, if you've planned for, let's just say, you know, $100,000 a year in retirement, adding an additional $64,000 a year can really shorten the amount of money you have for retirement so that you're not leaving one spouse outliving their retirement. And so in 10 years, if we're planning for, you know, if you're in your 60s and we're planning for a potential long-term care event in your 80s, we need to plan for $115,000 a year. And so these are the inflated numbers. And so, Jim, why don't you go ahead and walk us through what qualifies for long-term care?
Yeah, so there's something called activities of daily living. And this is something that the government kind of tracks and communicates because it ties into some government benefits. But the 6 activities of daily living, you can see those, and I see there's some people calling in. So these are bathing, dressing, eating, transferring, using the toilet, and continence. So if you need help with 2 of those, you may qualify for long-term care. So I know in my father-in-law's situation, he has difficulty dressing and he has difficulty bathing. And so he has impairments of activities of daily living. And, you know, these are obviously very personal in nature. A lot of people don't want to talk about this. I think there's also a lot of shame associated with some of these impairments of activities of daily living. But this is what they are. So there's that, or cognitive impairment. And this isn't just medical care. So this is somebody who might have, you know, might be fine, might be a healthy person. That was my mother-in-law. You know, my wife is the daughter of 2 Baptists. So they didn't smoke and they didn't drink. And we would have these continual conversations with them, or they say, my goodness, you know, your mother-in-law's mind is shot, but her body, you know, could last, you know, for a really, really long time. And it did. So cognitive impairment is where your mental function is compromised. And so the care that you receive you can receive it at home, in a nursing facility, or a residential care facility if you have cognitive impairment.
And I think the important thing to notate here too is most of the policies, and I'll say most of the policies today, allow your doctor to qualify you. So some of the older policies that might be 15, 20 years old, they required their doctor to certify you as in need of care before the policy would kick in and pay. The newer policies do allow for your own doctor to qualify you. I think that's important.
Yeah, that's really important, you know, and that highlights, Christina, that there's the old way of doing things and the new way of doing things. And these are really shifting sands. And the way things were done 5, 10, 15, 20 years ago is not necessarily the same way they are done today. So a big question, really kind of for a lot of people, the big question, how do you pay for it? Are there government benefits? Can you, if you have a stroke and go to a nursing home, is the government going to pay for that? If you have dementia or Parkinson's and go to a nursing home or skilled nursing care or stay at home, is there any government benefit available? And here's, on a very high level, here's the answer. You only get government benefits if you're in a skilled nursing care facility and you're poor. So for most of you on the phone here or on the video on Zoom, you're probably not going to qualify right now. So some people do modify their estate plan so that they can qualify for government benefits. But the bottom line, just sort of the talking point on this, is the government provides very limited benefits. There is some Medicare benefit. For example, if you get admitted to the hospital and you're discharged to a rehab facility, there is a Medicare benefit. It is very limited. It's limited oftentimes to a few days. By statute, it's limited to 100 days in any calendar year. So long-term care insurance. So if the government's not going to pay for it, can someone else pay for this? That's long-term care insurance. And in many cases, traditional long-term care insurance, frankly, is very expensive and has in the past been very hard to qualify for. And many of these policies are what we call use it or lose it. So use it or lose it. And what that is a lot like car insurance. If you buy car insurance for calendar year 2020, you pay the premium, thankfully you have no accident. You've lost that, right? That money's gone, it's never coming back. So that is, and we're going to talk about, that's not the way it is anymore. So there is a much better alternative that we'll be covering. And then there's what most people rely on is self-funding. And what is self-funding? You reach into your pocket and you pay. And so it potentially can wipe out your entire life savings, wipe out what you've worked for, and it can be wiped out with one spouse. So the sick spouse dies and the healthy spouse stays alive, but the healthy spouse has used all the money to pay for the sick spouse, and now the healthy spouse has nothing to live on. That is something that does happen, and that's frankly why you guys are here, to hopefully avoid that. So, Christina, do you want to talk about this?
Yeah. The question is, when people talk about long-term care, what is really the image in their mind? And most people initially, they think, well, gosh, I don't want to be in a facility. I want to be able to stay in my home. And so when they think of long-term care or having a long-term care need, they immediately think, well, that means I'm going to be put in a home, in an assisted living home or a skilled nursing home. And oftentimes that's really not the first place people need to go to receive care. And so the vision that they'd like, and 80% or more of people would like to have the vision of staying in their home. So even though that initial image might be staying in an old person's home, a nursing home, it really is the vision that they'd like is to be in their home. And most policies allow for people to stay in their home these days. And so there's also an up and coming, especially in Northern California, a up and coming type of CCRC, which is a continuing care retirement community where you can age in place or have an independent living situation and then maybe move into assisted living and then get additional care if you're in need of full-time care without having to relocate. And so maybe one spouse is independent living and one spouse needs, full-time care. There's an ability to age in place. And those do take long-term care policies when there's a qualifying event for needing the long-term care policy as well. So whether it be in your own home or in a CCRC, there are policies now that allow you to age in place.
Yeah, and one example of that, you mentioned Northern California. That's actually my in-laws were in a continuing care retirement community called Ponte Palmero in Cameron Park. Great facility. They had a home, a 3-bedroom, 2-bath home, kind of an attached duplex thing. But they had, at the time, my father-in-law was driving, my mother-in-law wasn't. She was getting in-home care, and then she moved out of the house into a memory care unit and was there for a while, about a year or so. And then her care continued to decline. And frankly, my father-in-law's continued to decline. And so they ended up moving to a different continuing care, retirement community under one roof instead of being in separate structures where you have to go out into the elements. But very popular, like you say, growing in Northern California. Do you see those as much in Southern California or not?
They're up and coming, but not quite as common. And I know we've got, both you and I have offices in both Northern and Southern California. And so we've got clientele all over the state, all over the nation, really. But we see some differences in the sense that more commonly in Northern California, you're seeing the CCRCs.
Okay. Do you want to talk about this, Christina?
Sure.
I think we're moving into your territory.
We're going to move into our territory, and then I'm going to introduce Scott to go through some specific scenarios of
can I just say one quick thing? This looks a lot like the cover of my book, Savvy Estate Planning, The Golden Egg. I have to put an ad in there. By the way, if you have a question, there is a Q&A box. There's a chat feature. Go ahead and put your question in there. I will also post the link to my book, Savvy Estate Planning, What You Need to Know Before You Talk to the Right Lawyer. I'll put that in the comment section, and it's available on Amazon. It's a top seller on Amazon, and we have our second edition coming out here imminently. So I'll give you the link for that. But Christina, take it away.
Perfect. So what we want to talk about is how you can protect and leverage your assets at the same time. And there's some ways to do this. We'll get into some specifics that Scott will talk about. But the great income gap in retirement, if we want to kind of go to the next slide since you're in control there, Jim, is that unfunded long-term care event. So if we had planned for $100,000 a year, I know with our clientele, our retirement plans, we look to take the youngest spouse to age 95. People are living longer. And because of the advances in healthcare, they're also living with diagnoses such as Alzheimer's for a longer period of time. And so what could happen is you could have that additional near $84,000 or $100,000 expense on an annual basis. For on average, a long-term care stay or need is on average just under 4 years. And so if on average under 4 years, that could really put a damper, an additional $400,000 or $500,000 for one spouse, not two, could really put a damper in someone's retirement plan. And then Alzheimer's, we've had many clients that have had an Alzheimer's stay or expenditure need for one spouse, potentially 8 years. So this is where we want to plan for the uncertain. And where does the money come from? A lot of times people can end up having to pull it out as a taxable event from an IRA. A lot of times people retire with most of their assets being in a retirement plan. So Jim, if we want to kind of go to the next slide here, this is just really, you've seen this in your world, in the estate planning world, where people come in and they go, what do we sell?
Yeah, this is so important because I will tell you, as a lawyer, I give a lot of legal advice, and sometimes my clients take it and sometimes they don't. And we ask them, is this important to you? Yes. Okay. Well, then we recommend you do these 5 things and we'll help you through them and we'll build this plan. But not everything happens as planned. And let me give you an example. Let's say you have a rental property, you have savings, you have an IRA. Which bucket should you pull the money out of? That's a really good question. A lot of people, they might have a savings account, but they have another kid on title to that account. Now, I'm not even going to get into whether that's a good idea or not, but do you take it out of that bucket? Or do you sell the rental property with the long-term tenants in there? And when you go to sell the property, that's a longer period of time. You have to get the tenants out. You may have to zhuzh the property up a little bit, right? Or do you withdraw it from an IRA? Many times the IRA is actually the easiest money to withdraw from. The downside with the IRA, as Christina mentioned, is anytime you pull $1 out, unless it's a Roth, and by the way, if you're thinking about a Roth conversion, please talk to Christina because I think Roth conversions are a great idea. But if it's not a Roth, you have to pay taxes when that money comes out. Now, sometimes that money can come out tax-free if you spend enough on medical expenses. and you itemize your deductions, but that doesn't always happen. So it's very important to consider, and it's not necessarily a legal document per se, but consider this liquidation plan. Which assets should be liquidated first?
Well, and very, very rarely will it make sense to do a Roth conversion over the age of 65, because you just don't have the time to recover the expenditure of doing so unless you're just marginally below a specific tax bracket and we can convert a specific amount. So that gets kind of into the weeds. But what I will say is, if you have on average, let's say $84,000 to $100,000 of an expenditure per year for a long-term care event in California, and let's just say you already had $100,000 of income for that year, and you then have to take out another $100,000 from an IRA, you just bumped yourself to the next tax bracket. So you didn't have to take out 100 to net 100. You might have had to take out 140 to net 100 after taxes. So that can wreak some additional havoc as planning on the taxes. And so, Jim, this is your favorite guy, Warren Buffett.
Oh yeah, there was one, somebody said, can you please increase your volume? So I think you're running off a speaker off your laptop. I happen to be speaking into the same, not the same microphone, the same model of microphone that Michael Jackson used to record Thriller. So just, my son's a musician and he hooked me up.
I'm trying to increase my volume, but I'm not quite as tech savvy.
All right. So you guys know who this is, Warren Buffett, right? The Oracle of Omaha. Warren Buffett has two huge policies of life insurance. I understand he had to actually buy a couple of insurance companies to get life insurance coverage. That's how big they were. But he also has long-term care insurance. Now, you might say to yourself, that's the dumbest thing I've ever heard. This guy has more money than most of the people on the planet and more money than many countries and continents, right? Why on earth would he self-insure for long-term care? It's the same reason when you go and pay cash for your Ford pickup truck or your Chevy, if you're a Chevy person, you plunk down 80 grand for one of these beautiful, big, decked out pickup trucks. You write a check for it. Do you get collision coverage on that car, on that truck? Absolutely. It would be a bad financial mistake not to get collision insurance on a new car. So it's the same concept. If there's an 80 or 90% probability that married couples will need long-term care, to not plan for it and not to insure it, you start looking at, well, that's not particularly financially responsible. So some questions you need to look at, we're not all Warren Buffett, right? So do you have an age gap with your spouse? Very important, all right? Many of our clients do have an age gap or a health gap. We can call it a health gap. So they might be the same age, but one maybe has more health issues than the other one. And the real sort of big question is, can you lift the person you're caring for out of the bathtub? I would say most people, if they're a couple and older, probably can't do that. And that's a really big sign that that you should be looking at long-term care insurance.
So we're going to have Scott Thurman.
Can you hear me?
And
oh yeah,
we can hear you just fine. Yeah. So Scott Thurman, Jim and I have been working with Scott for a long time. Scott is quite an expert in the long-term care arena. And so we're going to have Scott go through a couple case studies of some of the more modern products that exist. And this first one, Scott, I know you're going to highlight, we've got a lot of clients that have said, I'm okay sacrificing some benefits and bells and whistles to have an unlimited policy. And those did not exist even a few years ago. Maybe in the last 3 years, they've come around where there's policies that provide an unlimited long-term care benefit. And I personally, out of our clientele, have one client, their father was he was on a CalPERS policy for 15 years in a long-term care need. And then we had another couple clients that exceeded the 5-year mark. So again, the average long-term care stays just under 4 years, but there are policies designed for people to have unlimited coverage. So I'm going to let you kind of go through the next couple case studies, Scott.
Great, we're good right there. And at risk of you guys telling me to move, I'm going to move to the front and see how I look on video, because I feel like the Ant-Man all the way back here. So I'm just going to move around.
Well, Scott, you kind of are the Ant-Man back there.
I know.
Oh, Jim.
At least I'm a little closer now, right?
There you go.
So you mentioned CalPERS. Just a fun fact of the day. CalPERS currently has $1 million class action lawsuit against them because they raised traditional long-term care rates by 85%. And that's going to end up being a real big deal in California. So with that.
So wait a minute. Hold on, Scott. People who had these, are you saying these people who had these policies for years and years and years and faithfully made their monthly or annual or quarterly payment, the insurance company said, nope, we're raising your premium 85%.
Absolutely. Absolutely. And the problem with that is when you get into a long-term care plan, you do not want your cost to increase because you were going from your income making years to leveling out. So if you get a policy when you're 55 or 65 and then you're 75 and they're raising rates, it's very difficult.
Yeah.
So they're going to lose that lawsuit, I'm sure. I'm not an attorney, but I'm sure they're going to lose it. And what CalPERS has said is if they lose that lawsuit, they're going to have to raise rates more to cover the cost. So it's crazy. But let me give you an idea of one of these policies that Christina was just talking about. This is a single lady putting in $100,000 single premium, and for 33 months, she can have $3,000 going towards a long-term care benefit. The great thing about this particular plan is it has what's called a continuation of benefits rider, which is guaranteed and unlimited. Now, what that means is no matter what, it is guaranteed. The price isn't going to go up. It's a single premium, and it's an unlimited bucket of money. So you've transferred that burden of, if I have a long-term care event, how do I avoid spending down a lot of my assets, maybe all of them? And this is one way to do it.
So Scott, just to translate, because there's a lot of words up there. What this is you've got a single 65-year-old female. She writes a check for $100,000 to an insurance company.
Correct.
And she gets $3,000 a month for 33 months, and she gets $36,000 a year forever. How does this work?
You add a rider, okay? It can either be added up front, and that's what we did here as far as the cost. So it's all rolled into one premium payment, or you can give $100,000 single premium, or whatever the single premium is, whatever your threshold is, and then you could spread out the continuation of benefits rider over time if you want to.
And then if you never use it, where does the $100,000 go?
There's a death benefit, so it will go to your beneficiaries.
Good. So it's not use it or lose it. So you write a check for $100,000, you have a bunch of coverage, and if you never use that, your heirs get money. I love this. You know, I think I'll just say normal people, non-lawyers, non-insurance people. I counsel clients and I say, listen, you need to think of long-term care as gas in a tank. And imagine if you're going to get in the car and you're going to take a drive today and you don't know how long that drive's going to be. You might go to Reno. You might go to New York City. You might drive to Paris, like assuming there's a bridge there. You don't know how far you're going to go. If you don't know how far you're going to go, do you want to go with a full tank or an empty tank or a half a tank? I'm going to want a full tank, right? If I don't know how long the journey's going to be. This puts more gas in your tank. This puts more money in your tank for an uncertain future, because you don't know if, $3,000 a month isn't going to cover the cost of long-term care, but if it can certainly supplement the coverage. But if you look at it over the lifetime, over the time of the period of time that you're in a facility or at home, this adds more money. It creates more assets available for your care. So again, that's the analogy. You're going to take a drive of an indeterminate length. You want to go out with a full tank of gas. That's what this does. If you don't have this policy, you're going out with less than a full tank of gas.
And typically, Jim, oftentimes what we're looking at is just that, is supplementing. So if a client has Social Security and pension income or other investments, this is just a means to bridge a gap. And, taking maybe that extra $100,000 that's sitting in a CD that's not earning anything and not necessary for the plan, and repositioning that to fund long-term care. And what this illustrates here is that it's $3,000 a month with no compound inflation for the first 33 months, but after 33 months, that does have a 3% compound inflation annually for life to cover an event. So let's go to the next option here.
So we have a question here. David asks, hey, did Jim's parents or parents-in-law have long-term care insurance, and how did that work? What were the shortcomings? No, they did not. And I can tell you, my wife, who I just turned 51, she turned 51 last year. Yes, I married an older woman. She told me, as soon as we can qualify for long-term care, we're getting it. And Christina's helping us out with that, because my wife said, I don't want to do to my kids what my parents did to me. And I just want to set aside all of the financial talk. There were so many times when my wife came home after being with her mother, and she said, you know, I spend all this time worrying about how we're going to pay for stuff. I spend time doing laundry. I spend time doing chores. I spend time doing things directly caring for my mother. She says, I so wish they had just a couple $1,000s more a month, because there was a time, and we'll talk about this a little bit later, when we were really concerned that my in-laws were going to just frankly run out of money. And that's pretty scary. My father-in-law is a retired career military, and you know what? It's not enough. He retired as an E9, which is a Chief Master Sergeant, which is very respectable. It's the highest enlisted rank. And it just wasn't enough. And so many times my wife would come home and say, I really wish my parents had more money for their care, because I could spend more quality time with my mom instead of doing chores, frankly. And I know she regrets that. And that's why she's really prompting me and Christina to get long-term care for us. And then Pam asks, you mentioned if CalPERS doesn't win the suit, then it says we lost audio when you were finishing the sentence. If CalPERS does not win the lawsuit, the cost of the CalPERS premium is going to go up. So, Scott, if they lose the lawsuit on increasing their premium, their answer is to increase the premium? Is that the bottom line?
That's what the representative said, yes.
Yeah. So, I mean,
yeah,
that's
CalPERS
not a good
has
answer.
I will say that CalPERS, a lot of times it's difficult if people are 10, 15 years into paying into CalPERS. The last thing you want to do is, lose the benefits you've been paying for. So sometimes you're kind of stuck between a rock and a hard place. And I will say it's not a good position to be in. If someone's looking at signing up for CalPERS, I strongly discourage it, because they just don't have the increased inflation protection, and the premiums keep skyrocketing year over year for our clients. And it just becomes either what they've paid for provides less coverage, or their cost goes up to get the same coverage. So CalPERS is just not a good option going forward.
And then there's another question. Sorry, there's another question anonymously. Is there an elimination period? I'm assuming that means, is there a period of time where they say, 90 days after you become, you have 2 activities of daily living, then the coverage kicks in? If you guys can talk about that.
That's a great question. The answer is yes and no. On some of the products, there's no elimination period at all. On others, there might be a 90 or 100-day elimination period. So I think the important thing, and to add what you said, Christina, if you have an existing policy, let Christina or Jim look at that policy and analyze it, because just because you have a traditional policy, it may be perfect for you. The last thing you want to do is quit making payments on any type of a policy you have, or get rid of something without having a trusted advisor look over it and give you the right, advice on what to do. As far as elimination periods, as Christina analyzes your current situation and her team does that, what they'll do is they'll give you options on what looks like it would be best for you, whether it be keep your existing policy, get a new policy if you don't have one, or switch over. So really, it needs to be case by case, or supplement. Mm-hmm. You want me to move on to this next?
Yeah, let's go into this next slide. I think that this is a really good option. And I know, Scott, you and I work on a lot of cases like this.
Yes, this is a great option for a husband and wife. In this case, it's a 65-year-old male and female, and they have $200,000 that they put in it. Again, it's a lump sum. So they have the money available to be able to do that. You don't have to pay a single premium, but in this case, they do. You get $175,000 death benefit. Now keep in mind, this policy you do not want to buy for the death benefit. You're not buying it for the insurance. That is just to help make you whole if neither one of you gets long-term care or needs long-term care, has a long-term care event, I guess. So if one of you has a long-term care event, they'll receive $5,228 per person per month for 33 months. And then again, after that, we have the continuation of benefits rider, which goes unlimited, literally forever. If both individuals go on long-term care, then there's $10,456 of joint coverage available. So there's $5,000 plus for each of you, which is really amazing. It's one policy, covers both of you.
All right, so we have two questions from David. He makes a statement, you're promoting life insurance as your first choice solutions, and then a follow-up to that is, are there no good long-term care policies? So I think this is part of the old way versus the new way. I mean, I'll let you guys speak to that. I'm sure there are good policies where you pay monthly. That's one option. This is an alternative to that, and I will say that many of our clients would rather have a single payment, get it over with, okay, done, move on. I don't want a lingering $800 a month or $300 a month or whatever the dollar amount is. They just don't want that as a monthly expense. But here's the bottom line, and I'm going to kind of pull the curtain back sort of on the Wizard of Oz here. You can either give a chunk of money to an insurance company and they hold on to it, or you cannot give an insurance company a chunk of money and they don't hold on to it. That's really the difference between the two. And the life insurance with the long-term care rider, is my understanding is that's the only solution. That is the only solution that has a death benefit associated with it. So it's the only one that's not use it or lose it. Am I right on that, Christina?
There's some annuity options as well.
Okay.
So there are actual multiple options. So it could be a life insurance policy. It could be an annuity. And so what I want to go into this next slide, and I want to take a moment to talk about this, and then I'm going to have Scott kind of wrap up with just a couple other case options, examples here. We've just got a couple more slides to go through, and then we can, there's some questions in the queue, and we'll get to them. I believe we'll be able to address these here shortly. But for the sake of time, I want to just kind of get through a couple of these last examples. But this is one that Scott and I see quite often, where we repurpose either, and I say either, an existing life insurance policy or an existing annuity. So oftentimes people may have a life insurance policy that they've paid into for all of these years while they were working to provide for a spouse or family if they had a loss of income or pay off the mortgage. Maybe they're less concerned about that now because they're entering retirement, and they really are more concerned with that unfunded long-term care event. And so we can take a policy and exchange it in a tax-deferred manner or tax-free manner and get long-term care benefits. And so that also is the case with annuities. And under the Pension Protection Act of 2006, it allows us to take an existing annuity and exchange it into an annuity for long-term care that still has a death benefit, but the benefits that would otherwise be taxable coming out. So let's just say you put $100,000 in an annuity 10 years ago, and now it's worth $300,000. You got $200,000 of gain that would otherwise be taxable if you were to withdraw from that asset to pay for long-term care. If you put it into a specific long-term care annuity, that money comes out tax-free if used for a qualified long-term care event. So those two examples that Scott gave in the previous two slides, you can also fund those unlimited long-term care policies with an annuity. So there are some ways to just look at your portfolio and take existing assets and pivot and use them for long-term care.
Yeah, you know what? This is I love this strategy because I meet with a lot of people and they say, you know, I bought this annuity years ago. I put, you know, I put 50,000 into it, and now it's up to 150,000. And what happens when you pull money out of an annuity, you have to, where it says gain right there, you have to pay tax on your gain. And if you die and leave it to your kids, generally they can take 50,000 out on my example and not pay income tax on it, but the rest they're going to have to pay taxes on 100 grand. So there are some tax downsides to an annuity. What we're talking about here is someone with an existing annuity, not like going out and buying an annuity, then putting it in. But if you've had an annuity for many, many years and you're like, you know what, I had this annuity for reasons that no longer are particularly applicable to me, that's an asset that can be repurposed for long-term care.
Yep. So Scott, can you talk about the next option, which is a life insurance policy specifically, and this
Sure.
is another great option.
Okay, so I actually have this policy on myself, and just a quick overview. This gives a little higher death benefits for somebody who does have a little stronger life insurance need, maybe, which was my situation. I wanted to have additional protection for my family and my wife. So this particular lady, though, at age 65, she had another policy with $150,000 of cash value in it. She had a policy that she had bought years ago. The cash value grew, just like the annuity example. And Christina had come to this lady and said, hey, you don't have long-term care. Let's look at what this policy would look like if we put the information in and shoot it back to you. And it ended up $485,000 worth of coverage with $150,000 single premium. And so that money, that $485,000, can all be used for long-term care. None of it can be used for long-term care. All of it can be used for life insurance, or it can be used part of each. So what happens is she buys this policy. She immediately has a $485,000 death benefit and long-term care benefit. And if she goes on long-term care, she can use up to 4% of the face amount, which is the $485,000, 4% per month for qualified long-term care benefit. So let's say the policy was put into place. 3 months later, she finds out she has early onset Alzheimer's, and a year later, she's in a full-time facility. She could use up to $19,000 for long-term care. If she stays at home and has somebody caring for her there, let's say the costs are less, she could use as little as she needs. And it's really totally flexible. And the $485,000 gives a lot of peace of mind compared to having the $150,000, and can use for whatever you need it for.
So what you're so what you're talking about, Scott, is if this female who's 65 years old has a life insurance policy with $150,000 cash value, that's what you're talking about, right?
Yes.
Okay. So you have this policy, and a lot of my clients, and I have a policy like this that we're in the process of repurposing for long-term care, where I bought it a long time ago. I've made my premium payments. It does have a cash value. What does cash value mean? Well, that means, if you say, I don't want this insurance anymore, give my money back. That's kind of what I'm talking about, this amount of money that the insurance company's holding on. What you can do is you can put that in 1035 up there. That's called 1035. That's an internal revenue code section. All that means is you can go from one policy to another policy and then have all these extra benefits that she, if she got this policy of life insurance when she was 25, she probably didn't need all this stuff. When you're 25, you're not thinking about long-term care, right? But when you're 65, you start thinking about it. So she's taking an asset that she already has, and this is so important, an asset that she already has, and repurposing that to fit her needs, 40 years after she bought the policy.
And what I'll say is I'll wrap up with a couple things on this point, and we'll just go to our last example here next. But this is an option that we can also look at doing with premiums over time. So this example that we're showing is someone that's taken their policy and repurposing it. And one of the most important things to do is review your existing life insurance policies. People are living longer, and the cost of insurance has come down. So I can't tell you how many cases we look at where this client had $150,000 of cash value. Their existing policy had a death benefit of $350,000, with no long-term care coverage. We took it, we got her more death benefit and long-term care coverage just by reviewing her existing policy. So this is an example of an existing policy repurposing, but we can also design these in a way where someone says, okay, I'm going to retire in 10 years. I want to put in, you know, $10,000 a year for the next 10 years. Then I want to be done paying premiums in retirement and still have a benefit. So Scott, why don't you go through this example, this next example, which is someone that is planning for, they don't have an existing asset to repurpose. They want to plan for paying for long-term care.
Right, that's great. So this is actually a male, and it says age 65. It's actually a 55-year-old male.
Yeah, there was a typo. That this is an example of a 55-year-old male. So
don't worry, though.
apologies.
We sort of wanted to give an example, though, showing a gentleman paying in for 10 years. Let's say it's his last 10 years before he retires. He wants to retire at 65. He's got good cash flow, so he can put $1,000 a month in for 10 years. He does that. At the end of 10 years, he's paid $120,000 into it. And it can be returned to him in one of three ways. The first one is the far left. He can receive up to $334,689 worth of long-term care benefit. Okay, the benefit amount per month, which is right under max monthly benefit, is $36.40 if you're following. And the neat thing is it has 3% compound inflation. So let's say he does not need long-term care until he's 80. That dollar amount, that bucket of money, keeps going up, up, up. And so there's $700,000 available at age 80, and which is $7,600 plus in monthly benefit. Now, if he doesn't need that, let's say he's super healthy, and then one day it's just the end for him, and he just passes away. The second middle bucket shows $131,000 death benefit that would go to his beneficiaries. So his estate would be made whole by that money being returned to the family. In the far right hand, if let's say 6, 7, 8 years down the road, he decides, you know what, I need the cash back. I need it. He can get up to 100% of the cash back in this particular example. Now, the money does need to stay in there for 6 years before you can pull it out. So it does need to be in there a while. But at the very bottom, it shows each year how much you can get back if you decide to go that route. The one thing I will add to that is this is one of the most popular products on the market for the last 10 years. And nobody ever got the return of premium. It was like 2% of the people that took these policies out ended up saying, after a certain amount of time, I want my money back. And they used to automatically give 100% of the money back after 6+ years. What Lincoln decided to do in this particular case is they decided, let's give a much richer benefit for the long-term care and only offer 80% return back instead of 100%, because nobody's asking for their money back anyway. So now they give two options. You can either, when you put this policy in place, you can either go for, hey, if I want to turn the money, if I want to get my money back, I can get a maximum of 80%, or I can get a maximum of 100%. So give you some flexibility there. But there's no way in this type policy to lose for a person who has, let's say, $120,000 in a CD getting 0.00001%, and it's just a rainy day fund. You're just moving from one bucket to another bucket and expanding your options tremendously, and you're leveraging, and that's what we talk about with Buffett, you're leveraging your $1 for $7 at age 80.
Yeah, Scott, this is such a great, I can see this benefiting so many people. You got a male age 55. Hopefully the kids are through college. All those expenses are gone. The mortgage is kind of winding down, and you're hitting your peak spending years. So this is a great opportunity for somebody who is at that sort of 55 age to commit to premiums for 10 years. But I mean, this is fantastic because it relieves such this worry that I know a lot of people have. How am I going to finance, if something happens to me like it did my parents, what's going to happen? So fantastic. Are you guys want to answer some questions now?
Yeah, let's wrap up this last,
Okay.
I think we'll wrap up these questions and those last slides here. So really just to summarize here, you've got a couple different options. You can still do a standalone policy that you just pay a flat annual premium, $5,000 a year. It's going to provide $8,000 a month of coverage. You can do those policies. They still exist. I just have not written one of those policies in probably over 7 years.
Yeah, Christina,
so-
I do not see clients taking those policies out. Yes, they do exist. It's just these other ones are so much better.
Can I add
Exactly.
something to that,
Yeah.
Christina?
Yeah.
So my general agency, a lot of what we write is long-term care, and we do write traditional long-term care. And I will say in the last 6 years, we've written thousands of policies. In the last 6 years, long-term care policies, I can count on 2 hands, maybe even 1 hand, traditional long-term care. There's only 2 carriers out of the 40 carriers that we work with. There's only 2 carriers that even provide long-term care in the state of California. I mean, the biggest one, Genworth, went bye-bye a couple of years ago. And it's just, it was a good solution when it began, but now nobody wants the better option really for most people, if they're going to get a policy, is to do a hybrid, more modern policy. The carriers have changed with the demographics and the aging of America and life expectancies, and this works better.
Exactly. So those policies exist. Then we could also do a linked CD. So we can actually repurpose this CD that you can maybe get 2 or 3 times leverage. If you have a $100,000 CD, you might get $200,000 or $300,000 for long-term care. We can do a hybrid annuity or life insurance that has a long-term care rider where if you don't need it, you don't lose it. So there's various forms of funding, whether it be lump sum, repositioning, or funding a little bit pay as you go in preparation. So one of the questions from the audience was, do you do this before retirement? Do you do this after retirement? I think the best answer is planning for it prior to retirement. And how could we look at funding it? So the earlier, the better, especially if we don't have existing assets to reposition, because then you got to worry about how are we going to pay for this. And if you can pay for it out of earned income, that might be a solution. So it depends. It's not to say that it's too late when you're retired. I've got 75-year-olds that we've just placed long-term care for, and we simply repositioned a life insurance policy. So I think one of the other questions we had was, does it require a medical exam? So if we want to just go to the next slide, which I think we're just going to wrap up here with kind of who should consider long-term care and what is required of them. It typically used to require a full medical exam. If we're doing life insurance, it may still require a full medical exam. However, there are options out there like the pay-as-you-go one that Scott went over, and it had a $10,000 a year premium or $12,000 a year premium. It does not require a full medical. It's just a phone interview, and they do a prescription drug check, and they do an application, and they tell you within 72 hours, typically, if you're approved or not. So not all policies require a full medical exam. Some do. And the difference is clients that used to be disqualified for having diabetes or certain conditions, having had breast cancer, there are policies now that we can get them if they're maybe 1 or 5 years outside of a cancer event, or have had diabetes or currently have diabetes. So where it used to be a disqualification, there are now carriers that will take clients that have had past medical history. That being said, Scott, I know that you're seeing a crackdown on carriers that are starting to run scared after COVID. So while I think underwriting requirements have gotten loose over the last, I'd say maybe 10 years, we can now underwrite someone up to age 85. So if you're, but now it's starting to it might get tight again. It might get difficult again in the near future.
It could change, and really it's on a carrier by carrier basis. So we really need to look at the total picture with your clients. I will say the two examples we showed at the very first with the continuation of benefits right are the first examples. That carrier has just updated their rates in 49 of the 50 states. California Department of Insurance is very, very difficult to get past a rate increase, right? So the good news is they haven't raised their rates in California yet. So they're literally having a fire sale with people in California because they thought it was going to be approved at the end of the first quarter, and then COVID hit. And so everything went to a halt. But I anticipate, and we don't know the exact time, but I anticipate sometime, could be 3 months, could be 6 months, the rates are going to increase anywhere from 20 to 40% on that single premium that we just showed in the state of California. So we do have, I hate when people say, you have today to do this, that kind of deal with sales and everything, but no, you have a limited time to, if you really are thinking about this, to look into it and to get a better situation for yourself. So
well, we have a comment here, like essentially the comment says, look, buying the long-term care insurance, the amount you spend on the insurance is a drop in the bucket compared to the actual cost of long-term care insurance. And listen, hands down, I'll tell you, my wife is so upset at her parents for not getting long-term care insurance. And you're basically leveraging 2 to 1, 3 to 1, 4 to 1, 5 to 1. So you put $1 in and you're getting a multiple benefit on something that has, if you're married, a 90% probability. And I think we all know somebody who's had either in-home care, a lot of in-home care, or spent more, this is really critical, has spent more on their long-term care than their income. So their long-term care is greater than their income. Question about COVID. How does COVID impact anyone being able to qualify for long-term care? Are rates going to be skyrocketing? I will tell you that you may have noticed that your homeowner's insurance has gone up, your auto insurance has gone up. If you're starting to see these rate increases, what is happening in the insurance market is it's called a hardening of the insurance market. There have been a lot of claims. The fires in Australia, I don't know if you remember those, that was our winter, their summer, lots of damage. The hurricanes, the fires in California, the floods, all that stuff. When you have more claims, insurance companies have to collect more for premium. That's a bigger driver for the most recent increases than COVID has. But who knows what's going to happen with COVID? I mean, I don't know, Christina or Scott, if you have a thought on that.
Well, I mean, I'm not seeing anyone get disqualified for having had COVID. It's a virus. It's a respiratory virus. So, I mean, unless you're, in a hospital, it's got a 99.853% recovery rate. So, COVID, though, is going to make it probably difficult, I think, in general for life insurance claims. And I think that carriers are just going to start to clamp down on what they'll underwrite, what they'll accept. So while we can get someone approved with diabetes now, I don't know if that's going to be the case in 3 months from now. So I think that that's what we're seeing is just costs are going up. But we are able to get people underwritten with the COVID lockdown and shelter in place. Nurses are able to go on blood draws again and do in-home examinations if we have to. And again, some of these policies don't require an exam. They're just a phone interview. So if you're over 70, most often they want to do a phone interview to make sure that there's no early signs of dementia or Alzheimer's. So we're not seeing a direct effect because of COVID, but we're just expecting to see premium increases.
All right, so plan and documents to consider. Your plan should include durable power of attorney and have it be updated. Some of these have expiration dates, folks. Pay attention to it. I can't tell you how many durable powers of attorney and advanced healthcare directives literally have an expiration date. You don't want your stuff to expire. HIPAA authorization, very, very important. You cannot have access to someone else's medical information without your permission, right? So they have to give the permission for you to have access to it. So if I'm in the hospital, my wife can't access my health records unless I have a written authorization. The California Medical, the Confidential Medical Information Act is a state act. The HIPAA authorization has to comply. If you live in more than one state, you need HIPAA authorizations for each state. So if you spend time in Michigan in the summers and you're in California for the rest of the time, you should consider having 2 separate state authorizations. A living will says it's okay to pull the plug, to let me go if I'm a goner. That's something to consider. I'm not suggesting that you do it per se, but most of our clients do. Of course, a living trust. If you have not set up your estate plan, or it has been more than about 3 months since you looked at your plan, because guess what? The law did change in December of 2019.